Thank you, everyone, for attending today and spending part of your day with us. I'm Dan McIntosh. I'm the Chief Growth Officer here at Brady Martz, and I'm going to be hosting today's webinar with Angela Guptill on audit readiness and then the latest in GASB standards. We know that this time of year can feel super busy, like a whirlwind. So again, thank you for taking some time with us today. Our goal is to make things a little clearer and a little more manageable. From the Brady Mart side, we're going to focus on a few practical real world items today, including how to prepare for your upcoming audit and then the latest in the GASB standards. Really happy to have Angela Guptill today with us. Angela is one of our government experts and is here to break down both the technical side and the practical side of the upcoming items. Couple quick notes before we jump in. We are recording today's section. After the webinar, we will send out details on how you can access that recording so you can revisit anything and anytime you want. You'll also see a resources tab in the bottom of the webinar window. In there, we will have the slides posted for today's presentation, and we will also send those out later, but feel free to download those anytime. If any questions pop up throughout the webinar, just throw them into the Q&A section. I will be moderating this and keeping an eye on questions, and I'll tee them up for Angela at the right time as it comes. And if you think of anything later or want to talk through any specific situations, please feel free to reach out to us at Brady Martz. We're always happy to help. Let's dive in. I will hand it over to Angela.
All right, thanks, Dan. Hello, everybody. I hope you're having a great Thursday and staying warm out there. As Dan said, I'm Angela Guptill, and I'm excited to be with you today. Just a little bit about me. I have been a CPA at Brady Martz since 2018. I currently serve as Senior Manager in the Audit Department, where I focus primarily on government auditing. I perform audits for a variety of governmental entities, which include school districts, cities, airports, and park districts, and then also just a select number of nonprofit organizations. So if I can't answer a question for you, I can certainly find someone else who can, since we have a bunch of professionals here at Brady Martz in the government industry as well. The slide on your screen is the agenda for today's presentation. We will be going over how to prepare for an audit with some recommendations for what to do when closing your books for the year. I will give you a demonstration of the document request list software that we use, and then we will go over some recent GASB standards. We'll discuss how implementing GASB 101 went. We'll review what GASB 102 has in store for us this year, and then we will just touch on GASB's 103 and 104, which will need to be implemented in the coming years. Let's jump right into it and start with preparing for an audit. As I mentioned, I'm an auditor, so these are all recommendations from an auditor's perspective. The first step to preparing for an audit is to obviously close your books for the fiscal year. And closing your books start with reconciling all your cash accounts. It probably doesn't need to be said, but this is very important. If cash isn't reconciled through the end of the year, then there's really no way of knowing that all your activity was actually recorded. So from an auditor's perspective, it's very difficult for us to be able to issue a clean opinion if those aren't done and tying. Another reason why this is important is that usually if bank reconciliations haven't been performed consistently, there's likely to be problems with cash, and they usually only get worse as time goes on. So to avoid this altogether, reconciliations should be performed every month instead of just at year end. This is a very basic internal control that can catch mistakes and problems before they have the chance to snowball into something bigger. After you know that all your cash transactions have been recorded and have reconciled them, I recommend that you run a trial balance report and just go through it line by line to check your numbers. Using it kind of as a checklist, I would start by tying equity or fund balance to the prior year audited financial statements. Checking your equity numbers first makes sure that prior year amounts are right before moving on to your current year activity and numbers. If you start with your current year activity, but then equity is wrong, any corrections to equity are likely to flow through your current year and throw off those numbers that you have already checked. So you'd be doubling your work and you'd have to go back and fix those numbers again. If your fund balance doesn't tie to the audited financial statements, you probably have some journal entries to record from the previous audit, or they were just recorded incorrectly. Sometimes clients hesitate to record these because if they aren't reversed correctly, they can throw off bank reconciliations and accruals, and that's very understandable. So if you need help or if you're a little bit reticent about recording those, I recommend getting in touch with your auditor to make sure that you've done them right and everything ties properly. I personally have clients that do this, and it not only helps to make sure that your books match the audit, it can help to reduce the number of entries that the auditor proposes come audit time as well. So that journal entry report that you see is just a little bit less overwhelming. Back to that trial balance checklist. It's not a perfect metaphor, but I like to compare this review to something my English teacher told me back in high school. She recommended to her students that we read our paper out loud, submitting them for grading. And the idea is that while I'm the one that wrote the paper, when I read it out loud to myself, I'm listening to it as if I'm the audience, and it's easier to notice things that don't read or sound right. So similarly, a high-level review of the trial balance report is usually a quick way of checking your work, as it provides like a bird's eye view of things that you usually only see the details of while you're recording the day-to-day transactions. And sometimes that extra perspective can just help you catch things. If you're the person recording the daily activity, you know what activity happened throughout the year at your organization better than probably anyone. So you're likely to pick out any obvious errors pretty quickly. So using this checklist, there are some different comparisons that you can use to determine if things look reasonable. Usually for all your numbers, comparing current year to prior year is helpful and can highlight any big changes that need looking into. So for the income statement number side, comparing budgeted numbers to actual is good since your budgeted numbers would include any expected changes from the prior year, and in theory would only highlight transactions that were not expected since they weren't budgeted for. For accrual balances like accounts receivable, accounts payable, and payroll liabilities, sometimes just looking at them and asking yourself, does this look reasonable, can be really helpful. When you look at each individual account line, just stop and consider, did these balances increase or decrease as I would have expected based on what I know of the activity that happened during the year? Are there any negative balances in particular? And then you want to make sure that your interfund receivables and payables match. And then your transfers should match as well. And if they don't, then you probably have double recorded revenues or expenses, and stuff like that. Ultimately, if something looks odd to you, it will probably look odd to your auditor, and you'll probably have to answer the question anyway. So it's just a good way to be prepared. After looking at your checklist to make sure things look reasonable, next there are some more specific things that you can do to make sure your balance sheet accounts are correct. For accrual balances, specifically for things like accounts receivable and accounts payable, preparing listings or just reviewing software generated ones is the best way of ensuring that accrual balances from prior years aren't being carried over. So for payroll liabilities, you can compare your accrued balance to your last payroll register for the year to make sure it's accurate. Of course, that will depend on how many pay periods you typically have to accrue in payroll liabilities. And then for compensated absences, make sure that they're properly recorded in accordance with the new GASB 101 standard. So for example, check that they include salary related payments and you have your estimate calculated properly. We'll get into a little bit more detail on that later on. For capital assets, governments can be a bit unique, but regardless of how they are recorded on your books, you should track all of your additions and disposals or sales. You should especially track all your construction costs in detail, including retainage, as this is something that can often be missed or trip people up. If you prepare your own depreciation schedule, then make sure that you have everything added, depreciation properly calculated, and everything recorded on your books before audit time. And then if you've engaged with your auditor to assist with the preparation of the depreciation schedule, this information of the purchases, sales, stuff like that can be sent to the auditor ahead of the audit. Updating the depreciation schedule doesn't require having any other financial information ready ahead of time, like your trial balance or your general ledger detail. So the information could even be sent as soon as the purchase or disposal is actually made. I file client specific things in my email so that come audit time, I have that reference. And then if the auditor gets that information ahead of time, they can send you the entries to be made so that you can post them to your books before the audit even begins. All of these things will most likely be requested as part of the audit as well. So preparing them ahead of time just ensures that your numbers are right and that you're ready for the auditors at the same time. Finally, the last thing I will recommend doing when closing your books at the end of the year is to take a look at your federal revenues, if you have any. The threshold that requires a single audit has been increased to $1 million beginning for fiscal years beginning on or after October 1st of 2024. So this will affect your calendar year 2025 audits and financial statements. Please communicate to your auditor if you're over the threshold before audit time, if they don't know already. As a single audit is a bit more intensive than just a standalone financial audit for both auditors and clients. If you've experienced a single audit, you know this. Also before audit time and before even preparing your schedule of expenditures federal awards or CFA, review your federal revenues for accuracy. So if you have cost reimbursement grants, a good way of doing this is to compare your revenues and expenses for each grant. For cost reimbursement grants, the grant revenue is technically earned and receivable when the expense is incurred, which is a little bit unique. So revenues and expenses for the period should agree to each other. If this is not the case and revenues don't equal expenses, the most common reasons for these differences are either something was coded to the wrong account, or there's a missing accrual somewhere. Once you are confident in your numbers, you can start preparing your CFA. If you need a template for a CFA, ask your auditor or use the prior year as an example to follow. That should give you a good start. Once you have all of your federal awards added to the template that you have, make sure that your CFA is accurate. So I would start by tying your total on the CFA to your federal revenues on your trial balance. And then once it ties, I recommend comparing it to the prior year and doing a high level review of it, similar to your trial balance checklist. So look for any missing grants, or if there were new grants, were they added and were they added correctly? Do your names and assistance listing numbers, are they accurate? And if you're unsure whether certain funds are federal or not, or if you're missing an assistance listing number, we recommend reaching out to the grants funding agency for that information. Once you have your CFA prepared and you've gone through your trial balance checklist, you're well on your way to be prepared for your upcoming audit. I think we have a polling question, so I will pause for that. And then I will move on to our engagement organizer demonstration here. In order to make audit week a little bit easier on clients, Brady Martz implemented a file sharing software called Engagement Organizer that helps to centralize all of our audit requests for each client's audit in one place and then to track their status. This software is a secure method of sharing the financial information for the audit and can only be accessed by members of the audit staff and any clients that we add as client users. I've put together a test file to show you what this looks like, just in case there's anyone not familiar with it, and then to give a refresher course on its abilities to those that have seen it and worked with it. I'm just going to switch my screen. All right. There are a few advantages to using Engagement Organizer. One, we hope to keep your email inbox a little less cluttered during audit week, since it usually reduces the number of emails of us requesting items. Two, all the documents are requested should be in one place on here. So if two audit staff need the same document, you aren't asked for it twice. And then three, it can serve as kind of a live look at the status of our outstanding requests. So you should be able to see the engagement organizer test file now. In the top left corner of the organizer, you should be able to see all of the users that have access to this organizer, group by client and audit firm. Don't let me be in both sections confuse you. But then on the right-hand side, it has a send button that users can press when they would like to send a reminder email to the recipient. This goes both ways from client and firm. One note about this, any updates that the firm or the client make to the organizer can be seen live, essentially. So if you want the most recent version of the organizer or want to check if any new documents have been uploaded, you can just refresh the page. Any new changes or uploads will have a green dot next to them, like what's sitting by this clear button here. And those green dots will stay until you do clear them. They can be cleared individually on each line item or all at once using the clear button. If you want, the send button in blue is only for when you would like to send an actual email reminder to the person on the other side. So from firm to client or client to firm. The frequency of using this button is up to you. If you use it often, the recipient will be getting a bunch of emails telling them that you've made changes to the organizer. But if you don't send it, then the recipient won't know that you've made any updates unless they check it regularly themselves without prompting. Moving down just a little bit, you can see that there are 3 different tabs to the organizer labeled request items, notes, and attachments. Each tab pretty much shows the same information, just in different ways. So, for example, the request items tab shows the request itself down here with any notes and attachments towards the right. As you can see here, you can download or upload attachments directly from this step in a couple of ways. You can click directly on the attachment itself to download it, like so, or you can use the Manage Attachments option for downloading or uploading. And that is with these 3 dots here, Manage Attachments here. You can download the file directly, and then up here is where you upload. If you don't want a document to download to a zip file like it did when I clicked right here, I recommend using the Management Attachments option instead, or going to the Attachments tab, scrolling to the applicable step, which is just at the top here, and then downloading individual files you would like from here as well, because that will just download the file rather than a zip file. For uploading items on the Attachments tab here, you just go to Upload, drag and drop your file, and then click Upload. If you don't click Upload, it obviously won't upload. And you can do the same thing from the Request Items tab, like I mentioned earlier with the Manage Attachments option. You can also see a preview of any notes that are posted on a step from this tab. However, if a note is long enough, hovering over it on this tab will only let you see a portion of the note. So if you want to see the entire note, you have to go to the Notes tab. And if you want to edit it, you can do that here or delete a note. And as notes are added, the steps that they are on will be added on here as well. Otherwise, you won't see all of the request item steps. As you can see, there are individual lines for every audit request, and they're grouped in sections. So we have general information, cash, stuff like that. What you see here is just standard wording that automatically generates when we first open it. But if you use Engagement Organizer with us during the audit, you will see item requests that are edited to be specific to your organization. Each step can have a due date that lists the desired date that we would like to receive the document requested. If it's past due, the little yellow alarm clock on the left will show up. This is usually helpful in determining which items are top priority for the auditors or the ones we would like to receive first. The requests that we see right now are all of those that have been marked as pending. This is the default status, but the status of each item can be changed as they are completed, which is really helpful when you're keeping track of items that are still outstanding. Usually, if a client provides the items requested, the client or we, the auditors, mark it either as completed or accepted so that it's taken out of the pending bucket like so, and the only remaining pending items are those that are truly pending outstanding. If you're a list person, like I am, sometimes it's just satisfying to cross each of them off as you complete them. And obviously, if they aren't changed to completed or accepted, they will remain in the pending category. So I would just like to restate that the point of this is to keep audit documents in one place and keep track of any outstanding requests that the audit staff may be waiting on, or vice versa. And then to hopefully slow the overwhelming flow of emails in your inbox during audit week. If you're a Brady Martz client and you don't currently use it, but you see it as something that could ease the audit burden for you, please reach out to your auditor, as all staff at Brady Martz have the capability to set this up for you. All right, moving on to GASB standards. And Kate, this might be a good time for another poll potentially. This past calendar year, we implemented GASB Statement 101 for compensated absences. And I am sharing the wrong screen. That's probably better. The objective of the standard was to update the recognition and measurement guidance for compensated absences, and then to slightly change some previously required disclosures. There were two main changes that actually affected the numbers being accrued. The most straightforward change was to accrue salary-related payments. So your 7.65% of Social Security and Medicare, and then any associated retirement contributions for defined contribution plans. The second change was a bit trickier, was the portion that requires you to recognize a liability for leave that has not been used. In the past, the only way that you would recognize a liability for leave would be if it accumulates and it's paid out upon termination. With the new standard, a couple of nuances were added. The main one being that the liability should include any leave that is more likely than not to be used for time off or otherwise paid. This is regardless of whether or not it's paid out upon termination. The most common example of this that we saw was for sick leave balances that don't get paid out on termination. Using the old standard, none of these balances would have been accrued for. But with a new standard, since they have already been earned and the balance accumulates typically, you would have to estimate the portion that is more likely than not to be used for time off or otherwise paid. Again, this is regardless of whether it would be paid out upon termination. And since this is an estimate, it does allow a little bit of freedom in how you estimate this, but it still requires you to have a good explanation for how you came up with your estimate. So just be sure to show your work. As far as how the actual implementation went, I think the most frequently asked question we got was, what is this? So some other ways I've described it is that you are essentially accruing for amounts that the employee has earned the right to take time off for. Or I also think of it as if the sick leave expense is recorded in the year that the employee has earned their leave rather than the year it's been used or paid. Once everybody actually got into implementing the changes, we did have a few common mistakes. So here are just some reminders of what to watch out for when you're reviewing your compensated absences calculation. For retirement amounts that are accrued, remember to only accrue for defined contribution plans, not defined benefit. This means that your traditional NDPERS, RHIC, and TFFR plans don't get accrued, with one notable exception. The NDPERS plan obviously changed to a defined contribution plan on January 1st of this year. So if any new employees on that plan have balances in the leave calculation, their retirement does fall under this and should be accrued. Don't forget to accrue your FICA. And then some clients only provide information for staff that have met payout thresholds. The calculation should include all leave balances that are more likely than not to be used or paid, like the standard says, but regardless of when the policy says that they have met a threshold to be paid out. So if your auditor is helping you put together the calculation, just make sure that you include information for all of your staff, not just those that have met the payout thresholds. Sick leave pools need to be included in your accrual as well, and these can be easily missed. Finally, we've had some schools who have multiple leave policies for different types of staff. With this standard, you really need to look at it by each individual group as opposed to in the aggregate, because each different policy can have different carryover amounts, different payout thresholds, et cetera, things of that nature. Treating them with a one-size-fits-all approach will likely skew your estimate. If you happen to fall into this category, we have seen some Minnesota governments that have so many different contracts and employees and policies that they have engaged with an actuarial company to perform evaluation on the plan for this standard. If you're interested in getting assistance with this, some actuarial firms we've seen used were USI Consulting Group, or formerly Hildy, or via Actuarial Solutions. Okay, now that we've taken a look at past standards, let's take a look at the standards that are coming up. We have a light year for effective standards this year, as GASB 102 is the only one that is effective and should be implemented for calendar year 2025 audits. This one is mainly specifying the requirements for disclosures about potential risks from concentrations or constraints. While it is applicable to all states, state and local governments, it's mainly about definitions and disclosures and doesn't really affect the presentation of the financial statements or the numbers so much, like a GASB 101 or the lease standards that we had a couple of years ago. The definitions that the statement specifically lays out are on the slide here. The standard is specifically concerned with items or events that limit the government's ability to either acquire resources or control spending. So, in other words, if an event with a negative outcome happens to a government and could hinder a government's ability to borrow, satisfy its debt obligations, provide services, or pay for capital projects, that event would be an item to be considered for disclosure under this standard. The standard specifies what it means by concentrations or constraints, and examples of concentrations are found on your slide. A concentration, as defined by the standard, is a lack of diversity in any of these areas. So an example of a concentration in an industry would be like for um, a government whose sales tax revenue comes from like one shopping mall in the area. If that shopping mall in the area were to close, then you would lose that sales tax revenue. A common example of collective bargaining agreements would be like school districts with teachers unions. And if you want more detailed examples, the standards appendix C names quite a few. The constraint categories are mentioned on this slide. Limitations can be imposed by an external party or by formal action of the government's highest level of decision-making authority. So the board, city council can impose those limitations. A specific example of like a limitation on raising revenue that may affect quite a few of our government clients is the legislation that was recently passed that capped property tax increases to 3%. Again, if you want more detailed examples of other types of constraints, you can refer to Appendix C. So if you saw those examples and thought of some items that do pertain to you, don't panic. If you have a potential concentration or constraint, you don't have to disclose it just because it exists. You're only required to disclose if all three of these criteria are met, and the most notable one is C. So you can have a concentration or constraint, but you're only required to disclose it if an event has happened or is likely to happen within 1 year of the financial statement date, not year end, that could cause a substantial impact to your operations. If no such event exists or is likely to happen, you don't have to have any disclosure. Also, even if you do have an event that's likely to cause you problems, if you're able to take mitigating actions that lessen the impact that the event will have, you aren't required to disclose either. The standard defines substantial impact as something that impacts the government's ability to either continue to provide services at the current level that they're provided at in the current reporting period or meet its obligations as they come due. So, in other words, if it makes a substantial impact to you, it's a big deal and probably something that you've already been worrying about. Another loose way I interpret this is if you're in charge of the books at your government and you're not sure if an event will really cause any problems, then it's probably not going to need to be disclosed. Of course, if you're not sure and you want some assurance and you want to double check, you can always ask your auditors. If you do have an item to disclose, the standard also details the disclosure principles it requires. I think the most pertinent is that you have an item to disclose. This doesn't have to be a completely new footnote. It can be combined with any other current risk disclosures that you have in your financial statements. Another thing that the standard specifies is that it should be disclosed by applicable reporting units, or in other words, by fund, not just for the primary government. So if you have multiple funds with a concentration or constraint in more than one fund, each applicable fund should have a specific disclosure. Your actual disclosure and the notes to the financial statements should include these items. So the actual concentration or constraint, the event or more than one event, if that's the case, that caused a substantial impact to the government, and then any mitigating actions that have already been taken to reduce the impact, if any. And that is GASB 102. Okay, I'm going to pause here for some water. And then looking ahead to 2026 and beyond, we do have a couple of standards that will be effective. The first is GASB 103. This is effective for fiscal years beginning after June 15th of 2025, which means they're effective for your June 30, 2026 year ends and calendar year end 2026 audits. And it's applicable to all state and local governments. This is a pretty big one. It will have multiple changes, mainly to how certain items in the financial statements are presented, and it affects items in the financial statements that we commonly see in our client base. So it makes changes to management's discussion and analysis, proprietary financial statements, budgetary comparison information, And then less common are major component units and unusual or infrequent items. The standard specifies how it wants MD&A to look and then makes recommendations on the content within. And one of the changes that it makes is it details the 5 sections that it will require within management's discussion and analysis. And those 5 sections are listed on the slide. There had been previous feedback that MD&A explanations could be improved by being more thorough. So in order to address that feedback with the standard, the standard stresses that the detailed analyses section focus on explaining why balances changed, not just show how much they changed. Another objective of this part of the standard is it also wants to cut out any unnecessary explanations in the MD&A section that may be duplicated or remove any boilerplate discussions. However, one caveat is when it mentions boilerplate discussions, this doesn't include the explanation of the financial statements and their relationships, which is usually found in the overview of the financial statement section. And since this section is really expected to be pretty similar from government to government. Similar to GASB 102, within the statement itself for 103, Appendix C has a full example of management and discussion and analysis for a city, if you would like to kind of mimic that when implementing this standard for yourself. Since proprietary funds are kind of like your money-making funds, the standard thought it relevant to break out any information specific to subsidies, which are not exchange transactions. So it adds another subtotal to the income statement specific to subsidies right before the non-operating revenues and expenses section that is already on your financial statements. This can be for subsidies that the fund receives, so subsidy revenues, or subsidies that it gives to another party, subsidy expenses. The standard also specifies what would be considered a subsidy revenue or expense. A subsidy revenue would be resources either received from another party or fund that does one of two things. The fund either doesn't provide goods or services for the revenue that is received, or the revenue received either directly or indirectly keeps fees and charges lower than they would be otherwise if that revenue wasn't received. A subsidy expense is obviously kind of the opposite. So it would be resources provided to another party or fund that the other party either doesn't provide goods or services for or are recoverable through current or future pricing policies. So in other words, the government is losing now, but will make money on it later. Appendix C also contains an illustration of this and more details for reference. And on the next slide, I have an example of what it gives. If visually seeing things helps you like it does me sometimes, here's an illustration straight from the standard that lists all of the sections that could potentially presented on a proprietary fund statement of revenues, expenses, and changes in fund net position. This is the specific order that the standard requires them to be presented. But obviously, if you don't have any of these categories or items under any of these categories, you wouldn't have that section presented. The two main changes to budgetary comparison information within this standard are pretty straightforward, and they're just the two mentioned here. So on the actual face of the financial statements, there will be an additional variance column between your original and final budget amounts that wasn't there previously. In the past, it was, just your variance column from final budget to actual numbers. And then they are going to require an explanation of any significant variances, an explanation of those to be presented in the notes to the required supplementary information. I grabbed another illustration from Appendix C here, just so you can see what it looks like. Obviously, adding another variance column, um, it looks like what you would expect it to look here. And then here is an example of what that extra footnote would look like in the RSI, explaining any large variances from final budget to actual. The standard does note that it doesn't have to specifically look like this, like in a tabular format like they have. Governments can show it in other styles, like a paragraph form, if they so choose. Unusual or infrequent items are another thing that is addressed by GASB 103. This replaces the special and extraordinary items that we had in the past and just renames it to unusual and infrequent. And then it does make another presentation tweak similar to like the proprietary funds. Excuse me. Um, it's obviously in the name. You shouldn't see these very often, but if you do, it specifies how they should be presented. So um, an example in the appendix, again, it included grant revenues and cleanup expenses associated with flood damage as an example of an unusual or infrequent item, and they're listed in their own section. And if you can refer back to the proprietary fund slides, you can kind of see where it shows up, but the revenue and the expense are shown in the same section there. And I certainly hope that flood damage is an unusual or infrequent occurrence for most governments. Okay, the last thing that GASB 103 also addresses is major component unit information. So this really only applies to entities with multiple component units, so it's not something that we see as commonly. Uh, it requires major components to be presented separately in the statement of net position and statement of activities, with the exception that if it reduces the readability of the financial statements, you can do a combining statement. So there's extra columns for each major one, unless there's too many major component units and you have to combine them and potentially have a supplementary schedule. GASB Statement 104 is next, and that is effective for fiscal years beginning after June 15th of 2025, which means just like 103, they're effective for calendar year 2026 audits. And this one is essentially reinforcing the presentation of lease assets in the capital asset disclosures properly. GASB, it wants to stress that GASB 87 and 96, so for GASB 87 is the lease standard and 96 is the subscription or SPIDA standard. They are capital assets, they're leased assets, but they're considered and should be disclosed as capital assets and by each major class. So you should list them as leased equipment, leased buildings, not just the general group name of leased assets, and they should be included in your capital asset footnote. And then another main change is that it also requires an additional disclosure for any capital assets held for sale. Here's an example of what they would like the capital asset footnote to look like. I apologize if the text and the numbers are a little bit small, but as you can see, the lease assets are included here, but they have separate lines for each major lease asset class. There's a line for leased buildings, you can see leased equipment and subscription assets in both the asset cost part of the footnote as well as the accumulated depreciation part of the footnote. Here is an example of the disclosure that the standard is requiring for capital assets held for sale. The disclosure should include a few things, and while this isn't typically something that we see. It's definitely a possibility. The ending balance of capital assets held for sale, the disclosure should include that with a separate disclosure for historical costs and accumulated depreciation by major class of assets. So if it's a building held for sale, if it's equipment held for sale, it should have a separate disclosure. And then it should disclose the carrying amount of any debt that the asset held for sale is pledged as collateral for. That was a quick summary of GASB's 103 and 104. And I talked too quickly, so that concludes the content that I have for you today. Here's my contact information, just in case you would like it. It should be included in your materials as well. And then we have also included contact information for some other professionals at our firm. So if I'm unable to answer your questions when you do contact me, here's some other people at Brady Martz that can help you. Mindy is our government lead, and Brian and Bryce are very involved with governments as well. And it kind of helps that we're all spread out. So um, we've got different locations, obviously. So if you prefer somebody closer to you or something, that's an option.
We have the
Are there
final
any questions
final
for me?
polling question just popped up as well too. So, all right. Well, that brings us to the end of today's session. Angela, thanks a ton for walking us through all that, especially the practical audit prep tips, and then the things to keep in mind as you're looking at the new GASB standards as well too. And all of you joining us today, thanks again for your time. We know you have a ton on your plates, especially this time of year. Really appreciate you being here. Again, a couple quick reminders before you hop off. This webinar was recorded, and we will send out a link to where you can access our recording. So if you want to go back and rewatch a section, share it with someone that's on your team, you will have that available. If you think of any questions later, or if you just want to talk through how any of these items, apply to your specific situation, please do not hesitate to reach out. Again, all the contact information provided there. We are happy to be a resource. When we end this webinar, a survey will launch, and we would really appreciate your time to just take a minute and complete it quick. The information that is in these surveys really helps us hone in on what topics and presentations for future trainings as well. So thanks again, everyone. Have a great rest of your day, and we hope to see you at future Brady Martz webinars soon.